Hello and welcome to Money Markets and More with me, Dominic Frisby, from the wet streets of Nottingham. I'm here doing a gig. That's Nottingham Castle, you can see behind me. And today we ask, is that it? Is the bear market over? Now, we've seen incredible rallies across the board this week. After a worrying sell-off late into the day last Friday into the close, the Dow and the S&P 500, they both took off on Monday, rallying by over 3%. They then followed through with gains of another 3% on Tuesday. The Nasdaq was up by even more. And given that tech was so totally beaten up, I guess the fact that it had a bigger rally is no surprise. Look, I'm guessing that's Robin Hood. Great tax rebel. Now, you could apply the same logic to precious metals. Silver sold down into the abyss. It rose by 8.5% on Monday. And so my call for a multi-week rally in silver is looking pretty good. And even the once internationally sought-after currency that is sterling had a barnstormer week. A week ago, everyone was talking about parity with the US dollar. It was all over the headlines, which usually means it's time to take the other side of the trade. Even Turkey's President Erdogan, with a display of hypocritical chutzpah that would capture the imagination of even the most duplicitous of tyrants, was deriding sterling. He said it's blown up. He's obviously not been looking in the Forex mirror lately at his own lira, it seems. But anyway, sterling went from $1.03 to almost $1.15. Now, I want this bear market to be over as much as you probably do, and I hate to go all prophet of doom on you, but these kind of rip-roaring rebounds are just that. They're just rebounds. They're not typical of bull markets, and I'll give you some depressing statistics. 1929, 1931, 1932 and 1933 were amongst the worst years in US stock market history, famously so. Yet on a percentage basis, the 10 biggest rallies in the Dow Jones Industrial Average in the first half of the 20th century all took place in those years. Prior to this decade, the best days in the stock market since 1950, according to J.C. Peretz of All Star Charts, were 1987, 2002, 2008 and 2009. And again, 2009 aside, these were not good times to buy stocks. These kind of spikes are not typical of bull markets. That's not to say they don't happen in bull markets, but they're more typical of bear markets. Bull markets tend to grind higher. Increased volatility, heightened fear and risk, big up days and big down days, short squeezes. These are all things you see in bear markets. Indeed, it's a typical short squeeze. There have been lots of sellers. There are lots of people with big bets that prices are going to continue falling. A lot of shorts, in other words. And then suddenly, there are no more sellers in this crowded market. And as the price turns, the shorts quickly cover their positions, which means there are suddenly lots of buyers and the market rockets higher. It's the sudden and rapid covering of short positions that causes the spikes up. Now, of course, sometimes you get these spikes at the final low. March 2009 was one example. March 2020, at the height of the corona panic, was another. The problem is that on the way to that final low, there have been many such up days and down days. So in real time, you don't actually know which is the final one. Now, from false moves come fast moves in the opposite direction. That's a phrase you may have heard me utter quite a few times. And Friday's down move, or last week's down move, was a classic example. A breakdown to new lows, below the June lows. Everyone thinks we're going lower. Rumours are flying about that there's an emergency meeting of the Federal Reserve Bank on last Monday. Credit Suisse is going under. Credit Suisse has got bigger derivatives liabilities than Lehman. Everyone's panicky. I'm talking about Lehman in 2008. And the market turns around, rips everybody's faces off as it goes higher. Now, as we've seen, most markets have turned down again. And it's hard to tell if what we're seeing is consolidatory action after the gains of the last couple of days, or we've already started on our next leg lower. And if you look at a chart of the stock market this year, how many roaring up days have there been this year? And yet it's been a horrible day for longs. Now, an obvious magnet for this move is there's a falling blue trend line, and it's currently around about 4,000. Another target would be the 850 to 3,900 area. But, you know, these are all, I mean, these are very, very difficult markets. I keep saying it. I mean, what do you think? Is this the final low, or have we got more bear market action to come? Price action tends to set the narrative, and the stock market tends to lead the broader economy. So even if you are of the mind that this economic downturn is not over, the stock market can still quite easily go higher. We're going into a good seasonal period for stocks. October's normally a good month. It's one of the best 3 or 4 months of the year, I think. There's probably too much pessimism about. We've got the US midterm elections in a month or so, which will give us a better idea of where things are going politically. I change my opinions as events develop. I always do. We all do. But I've got to say, for now, I think the likelihood is that this is a bear market rally. And as for the silver, I don't think this is the beginning of the big kahuna back to $50. And on this move, low to mid-20s is my target. But thanks very much for watching. Wish me luck here in Nottingham. Please subscribe to my channel. Please subscribe to my Substack. I'll be back with another video very soon. And if you are in the New Orleans neck of the woods next week, come to the New Orleans Investment Conference. I'll be there. Cheerio.